Welcome to Real World Real Estate, where we will explore, examine, and explain the real process of buying or selling real estate. Here is your host, Stephen Clyde.
Hi, everybody. Welcome back to Real World Real Estate. This is Stephen Clyde, your host with RE/MAX Preferred and RE/MAX at Cherry Hill. And today we're going to be talking about homeowners insurance. Everyone has it, anyone that owns a property or rents a property, but willing to bet that over 90% of us have no idea what's in those policies and what makes them up. So today we're going to be interviewing Randy Tann with Edgewood & Associates in Berlin, New Jersey. Randy's third generation insurance broker. I've known him and his family for longer than I want to admit. He not only writes my personal policies for me, but also we refer all of our clients to him to get their quotes. And he's done my daughter's policies, my goddaughters, my nieces, my nephews, my sisters. You know, we do truly trust them. We use them personally, obviously. Randy, I appreciate you joining us. Sorry for the couple technical hitches we had in the very beginning of this that the audience didn't hear, but thanks for coming on board and spending the time with us to explain homeowners insurance to everyone out there.
Yes, thanks. Hi, Steve. Thanks for having me. Hello, everyone. Just to go on a few other things, my background, I have been involved with insurance pretty much my entire life since I was born. Like Steve said, third generation. So my office was started by my grandfather back in 1956, so we're approaching our 65th year in operation. I've been personally licensed in the insurance business and writing it for the past 20 years. I went to Camden County College, where we studied small business management, and then moved on to South Jersey Professional School Business, where I was licensed in 4 of the 5 authorities, property, casualty, life, and health insurance. So pretty much I can help you in any of your needs as far as business goes. If you own a business, commercial, workers' comp, general liability, business auto, as well as personal auto, homeowners, and all your recreational things as well as boats and motorcycles and things like that, RVs.
Awesome. And just so everybody knows, in the show notes, we have all of Randy's contact information. So when the show's over, if you want to discuss any of the topics we covered more in depth with him and your personal situation, your personal property and everything, all that contact information will be in the show notes at the end, so you'll be able to reach out to him. All right, so Randy, before we get started and we start talking about the policies themselves, we're in hurricane and storm season along the East Coast right now, from the tip of Florida and the Gulf Coast, obviously. And my understanding that if I was going to get ready to go to settlement Monday, if I don't have my policy in place right now, depending on where I'm at in the country, I may not be able to get an insurance policy right now, right?
Yeah, they go by the projected path of the storm, and they, in Louisiana, Texas case, they probably suspended, they call it, all binding authority, which basically binding means making anything in force or effective. Usually these restrictions start happening a day or 2 prior to the storm happening, sometimes, 3 or 4 days even prior to this happening. So, if you lived in Louisiana, Texas, and you're going to settlement this Thursday, you probably, if you didn't get your policy bound, were not able to get it bound because everything was shut down, and now your closing had to get delayed or pushed back. As the storm continues its path, then the cone projection of the storm, they will start restricting binding authority along that path. Right now, New Jersey is okay. We are not having any restrictions. The last storm that moved through, we did have restrictions, and they did shut us down for about a 2-day period until the storm passes. These restrictions are not just on new business, it's on existing business that you may call up and say, I want to lower my deductible, storm's coming, I have $1,000 deductible, let me drop it to $100 real quick, because if we have damage, I don't want to have $1,000 out of my pocket, I'd rather have $100. Can't do. They just stop everything. Same thing goes for not just storms, Stephen. Hurricane, nor'easters would be a factor. Flooding, a lot happens in the Midwest. If there's bad rain, flooding, they'll restrict coverages there. Out west, you have the common wildfires that occur. Once these fires occur, same thing goes across the board, they start suspending anywhere where they think the projection of that fire is going to.
Okay. All right. It makes sense for the insurance company. They don't want to take on brand new risk when they know the risk is just intensified tenfold because a hurricane's about to hit. So it makes logical
Yeah,
sense.
you write a $1,000 a year policy on a $500,000 home, and then the next day it's gone. The insurance companies are in the business to make money, not lose money, unfortunately, and that's statistically what they look at, and that's what insurance is. It's statistics, basically. It's how they factor and come up with the premiums.
So I know you and I discussed this with my policy prior, and it really ties into the season we're in now because of storms and wind and tornadoes and everything as we get in more deeper into the fall. So not all policies are created equal when it comes to this stuff, right? So they can
True.
ding me with a hurricane deductible or a wind deductible or something like that, right?
Yes. So a lot of companies out there, and we won't mention the names of those companies, but if you want to call me after the call's over and you have a policy you want me to discuss or review and find out if you have what I'm about to go over, is these companies, they automatically, whether you like it or not, you have no choice in the matter, they require you to have what's called either a wind or hurricane deductible. And basically they call it a percentage. Most of the time, these companies put on what's called a 2% hurricane deductible. So what does that mean? You have a $400,000 home. Your home's insured at $400,000. A hurricane hits and damages your home. Then you have damage to your home. You call up. Siding was ripped off. Some shingles blew off the roof. Maybe whatever the case might be. You call the insurance company. Tell them what happened. They come out and they inspect the property and they say, okay, you have about $6,000 in damage here. And you go, oh, great, I only have a $500 deductible. This is wonderful. And they go, no, I'm sorry, you have a 2% deductible. You're a 2%, what do you mean by that? Well, 2% of $400,000 comes to $8,000 deductible. So in that situation, a lot of people believe they just have a $500 or $1,000 deductible, which is very common on most homeowners policies, and they don't realize that the company threw in a 2% hurricane deductible. So in the event of the hurricane on the $400,000 home hits you with the 2% deductible, you're at an $8,000 deductible. So in that $6,000 of damage, you're SOL. You're fixing damage yourself. The insurance company denies the claim.
Wow.
Now, on another note, Steve, it's not. I would never do that on anybody that's 5 miles or away from the coast out. But within 5 miles of the coast, there's like a line in the sand, basically along the eastern seaboard. I can't speak for the west. I'm not real sure, but on the eastern seaboard, there's a line in the sand about 5 miles is what they do, and they require, every insurance company requires a mandatory wind or hurricane deductible. But it depends on the company you're with of what that deductible can be. You could go a 1%, a 2%, 3, 4, or even 5%. So on a property in Ocean City, New Jersey, as an example, on the beach, $800,000 home, they may have a 5% hurricane deductible. So on an $800,000 home, they're looking at a $40,000 deductible. So you could call me up and I could say, wow, you have a 5% deductible. I could get you the same coverage with a 1% deductible, which in that case would be obviously a lot less money out of your pocket.
Right. Now I went from 40 grand to 8 grand.
Exactly.
And I'm assuming they apply it to everyone because it allows them to compete pricing wise, right? It's going to lower the premium because you've got this exorbitant additional deductible you didn't know you had.
Yeah, so obviously the higher your deductible or the higher your percentage wind deductible, the lower your premium.
Okay. It makes sense, but it's a little, I'm not going to use it.
The amount of money you save for having the higher percentage deductible from a 5% to 2% is pennies. It's not even worth it. So if somebody out there has a 5% hurricane deductible, lowering it to a 2% is maybe going to save you $100 a year. So it's a no-brainer to pay the extra $100 a year to have a much lower percentage deductible.
And the same thing would apply to me. So I'm 40 miles in from the coast, but if I happen to have called one of these companies for my quote, so let's say I talked to you and you said, all right, Steve, your house is $1,000 a year. And I go, all right, well, XYZ from the TV commercials, they only quoted me 800 and it's the exact same coverage. So
yeah, I usually say, Steve, send me your policy. Let me see the quote you just got. And I like to look at it, review it. There's always usually a reason why it's lower. Sometimes not. Sometimes the other company's just better. And I say, hey, that's a better quote. You got to go with it. But usually what I would see in this case, as we're talking about this, I would say, look, they slapped on a 2% hurricane deductible. That's why it's lower. Do you really want to save the $200 a year for having this higher deductible? Even though you are inland, it doesn't mean that you can't suffer damage from a hurricane. We just had the hurricane here recently, I forget the name of it, that we were shut down for those 2 days. We had 60, 70 mile an hour winds around here in Camden County, New Jersey, which is near Philadelphia. We had lots of trees down, power wires down, people without power. There was siding blown off, shingles blown off. Most of the people that I wrote coverage, well, all the people I write coverage with in this area would never have to worry about that because I would never put that on their policy. I don't have companies that make it mandatory. It's the big name companies out there that usually carry this as a mandatory deductible, and you have no choice on the matter. And they usually don't tell you about it either. And if you're looking at your policy, it doesn't really jump out. You see this 2%, and it's like, oh, well, what's that mean? I don't know. It doesn't explain it.
I mean, the policies are hard to understand to begin with.
You have to be a lawyer or an insurance agent to understand.
Yeah, that's the whole point, right? So in that case, I think it was called Aisha or whatever that storm's name was. Right, we got hit with a lot of damage, a lot of tree damage, a lot of wind damage. We had huge gusts. So I thought I was covered. My siding blew off, and like you use your example, I lost a quarter of my roof shingles. Now I thought I had that $1,000 deductible, and they're coming out and telling me that it's $8,000, or I'm denied because it's less than my wind coverage deductible, right? So I'm really not going to learn about this until I need it. Pretty much is what we're saying.
Yeah, and you're going to be a pretty unhappy camper, when you find out you had a $5,000 deductible for damage around here in the Camden County area, Burlington County, the South Jersey area that's non-coastal. You're going to think, oh wow, I had $4,000 in damage. This should be covered. I only have a $500 deductible. I'm going to get $3,500 from the insurance company. They come out and go, nope, sorry, you had a 2% wind deductible here, and you got no coverage. You're going to have to fix this yourself.
And that would apply. I'm sure you remember we had it here in Berlin and Camden County. I think like 5 or 6 years ago, we had that significant windstorm that came through. It was basically a tornado that never touched down. And that would have applied there too, even though it wasn't a hurricane, it was wind damage, right? So that's
exactly. So there is a separation, and most companies throw what's called a hurricane deductible. There is also what's called just a wind deductible. A wind deductible is worse than a hurricane deductible. So in your example with the tornado, a tornado is not a hurricane. So if you have a hurricane deductible and a tornado hits, that's just wind damage. That's not hurricane damage. You got coverage same as the regular deductible on your policy. So having a hurricane deductible is better than a wind deductible. A wind deductible, basically any type of bad thunderstorm, nor'easter, tropical storm, hurricane, anything that's wind damage, so you have a higher risk that you're absorbing with any type of wind versus just a hurricane. So there is that separation. And like I said, most companies, they just apply a hurricane deductible. But there are companies out there that throw a wind. And if you see wind deductible, that's actually worse to the insured.
Wow. Okay. All right. So everybody take a good look at your policy. Make sure, you don't have these hidden deductibles in there. Obviously, if you have a coastline property, you don't have a choice. West Coast, neither one, Randy or I are 100% sure. But if you're coming from Key West to the top of Maine, and you're outside that 5 mile line in the sand, so to speak, or whatever that line is, because that would change coastal, right? Or is it 5 miles straight down the coast, no matter what?
All the insurance companies I deal with in New Jersey, Maryland, Delaware. I can't really speak for Rhode Island and up north and into Maine and those places, but I would guess I'd be pretty confident that they pretty much all have a 3 to 5 mile line in the sand along the coastline. So if you took a map and looked at it and drew a 3 to 5 mile line right down it from the tippity top of Maine to the coast of Florida, I would imagine it's the same thing.
Okay. All right.
Florida may be a little different, Steve, just because it's stuck out into the water. So the whole state of Florida may have these type of things.
Well, yeah, and they have separate hurricane insurance policies that they have to buy on top of their regular homeowners.
Yeah, I believe they do. I don't write down there, but I'm pretty sure that I've heard that.
Yeah. All right, so let's move into a regular policy. Right? I'm going to buy my first home, and or my client's going to buy their first home, and I give them your name and number to call because we've been estimating what their insurance is going to be to work out their mortgage payments. Now we need to get the actual insurance premium because we needed the house in the contract before we got to that point. So, the buyer gives you a call, and what do they need to be able to give you to start that process?
Well, it's pretty easy these days because of the internet being so wonderful. They just got to give me their name, when they're going to closing, and the address of the property. That's basically what I need. I do need to usually have their date of birth as well as their current living location. But once I get that address, name, date of birth, and current location, I can go on the internet and pull up properties, usually the realestate.com or Zillow or one of these web addresses that you pull up will have tons of photographs of the property. So I can click through the photographs and get a lot of the information right there. Square footage of the property, number of bathrooms, the number of garages, the style of the home, the age of the home, foundation, all the different particulars I need in order to calculate what we call the guaranteed replacement cost of your home. So you may be getting a loan through your mortgage company for $350,000, and you may be purchasing the home for $400,000. So you're putting $50,000 down on the property, but you have a $350,000 mortgage. Well, that doesn't mean that that's what I'm going to write your policy for. I don't care what you're buying your home for. I don't care what your loan amount is. I want to insure your home at 100% of what the insurance company and I feel it would cost to rebuild your home. So different areas of let's just say in Camden County, New Jersey area right now, there's some higher end neighborhoods that you may pay $400,000 or $500,000 for a home, but down the street in the next neighborhood over, that same exact home, if you lifted it up and planted it down, is only worth $200,000 in the real estate market. Just because it's worth less in the maybe less desirable neighborhood doesn't mean I'm not going to insure that home at the same price. So a property, for instance, in Ocean City, New Jersey, we'll use 2,000 square foot colonial home.
$1 million.
That may be worth $1 million. Exactly, $1 million. I'm not insuring it at $1 million. It's a 2,000 square foot home. So usually on a 2,000 square foot home, just real quick ballpark, we usually use about $170 a square foot. And this is just to get a quick estimate. We do something much more detailed. We have a tool to place in the computer that spits out a more accurate number. But that would be about $350,000. It comes out to $340,000, but let's round it up to $350,000. You just bought $1 million home in Ocean City on the beach, and then I call you back and give you a quote for $350,000, and you go, well, wait a minute, I just paid $1 million for it. Well, it's location. You're on the beach. You're in Ocean City, New Jersey. It's the land that's worth the, probably 80% of that. And it's not the home. So same thing. You lift that house up in the air, put it on a flatbed truck. Now drive it down to Camden, New Jersey. And if people aren't familiar with Camden, New Jersey, it's probably one of the worst cities in America, probably one of the highest crime rates. You're putting the same exact home in that area. That home may be only worth $50,000, $60,000, $75,000 in the real estate market, but I'm still going to insure it at $350,000. So people can't understand, what the home's worth or what the mortgage amount's worth versus what the insurance was worth. It's all night and day, apples and oranges. So, yeah, okay. After I explain that to people, they usually get it. So, they call me up, like you said, Steve, what do we do? I get the address, the name, the dates of birth, the current living location. I find most of the information online. And then there's a couple personal questions that could maybe make or break the whole deal. Do they have dogs is a big one, or trampolines. So if you have a trampoline, yeah, go ahead.
I wasn't.
What was that?
You know about the trampoline part. I knew about the dog part.
Yeah. So trampolines can be a problem with some companies. They don't want them at all. Other companies say, well, we'll take them, but the yard must be fenced in and it must have a safety net around it. So if it's one of the trampolines with no safety net and you don't have a fenced in yard, the companies that are okay with them will say, well, no, we're not okay because your yard's not fenced in and the trampoline's not netted. So obviously the concern there is injuries of the kid or an adult falling off the trampoline, breaking a neck, a leg, an arm, whatever the case might be. And, not just a kid that lives at the home, but, it's usually their friend that comes over that does it. And that's where the lawsuit comes into play when that kid gets injured. So besides the trampolines, though, I was talking about the dogs. This is usually a bigger case. They have what they call an aggressive dog breed list. And top 4 dogs on that list, there are others, but the top 4 are obviously the Pit Bull, the Rottweiler, the Doberman, and the German Shepherd. And believe me, there's probably a lot of dog listeners listening right now, and they're like, well, my dog's a Pit Bull, and it's the greatest dog ever. You're right. It probably is. It would never harm a soul. But unfortunately, a couple bad apples ruined it for the entire bunch. So the insurance companies say these type of breeds, even if it's a mix, say Pit Bull Boxer or Lab Shepherd mix, nope, we will not write your policy. You are not eligible to come to our carrier. Now, saying that, I'm lucky enough that I do have a lot of carriers that I write with at my agency. I'm not like certain companies. They only write with that company. I write with 12, 15 different homeowners carriers. So I do have a market in the standard preferred market for people that have Pit Bulls, Rottweilers, Dobermans, German Shepherds. So if you're paying more money right now because you're in a surplus lines carrier, which would be a higher risk company, you called around and nobody could write your coverage for you other than in a surplus lines high risk company, you could call me and I could get you out of there and write you with a preferred standard company that would provide liability coverage if the dog did bite someone, because most of these other high risk carriers that will write you for double the premium because of you having that dog, they have what's called an animal exclusion on the policy. So even if that dog bit someone, you have no coverage for it and you're paying double the premium that you should have been.
Wow.
Now, swimming pools are also another factor in the properties. They don't make the premium higher, but then they want to know if there's a diving board or a slide. Some companies don't like diving boards or slides at all. Some companies are fine with diving boards and don't like slides. Obviously, the yard has to be fenced in and locked and gated. So there's some of the requirements. If it's not, then you're not eligible again. Bankruptcies are a problem. If you had a bankruptcy, a lot of companies say no. We do run credit. That's why we need your date of birth, current location where you live now, and the new location. It doesn't come back to us with any information. It's private information. It comes back with what's called an insurance score. And let's say an 01 is the best score, you get the best rate. If it comes back a 36, well, that's the worst rate. But we just know that your credit's not that good if it comes back as a 36, but it doesn't tell us any personal information. So insurance companies do affect your credit does affect your premium with most insurance companies. So if there's someone out there who has a bankruptcy, I had a bankruptcy or they didn't have a bankruptcy and I'm doing the quote and it comes back a 36, they just have not the best credit in the world. I know to go to some other carrier that doesn't judge you on bankruptcies or credit. So I have preferred standard companies that will write you with a bankruptcy and if your credit is not so par, let's say. But if you do have good credit, we go to these other carriers that basically pat you on the back for it. And the people are saying probably right now, scratching their head, like, what's credit have to do with anything? Well, Bottom line is, in insurance, everything's based on statistics, and people with better credit statistically take care of their property better. If they see something wrong with it, they're going to go take care of it. Their gutters the downspouts off, and the water's running down the side of the foundation. A good credit person, they're going to go and take care of it and be responsible, versus they say people with not so good credit are not so responsible. It doesn't mean everyone is. It's just like the dogs. There's a few bad apples that ruin it for the bunch, but statistically, the people with not so good credit don't take care of their homes as well, and therefore claims occur. And when they do, they end up being a larger claim than someone else that does take care of their property better.
It makes sense, and these are what the actuarials are doing with the statistics. They're saying an 800 credit score is a less risk than a 580 credit score, or whatever their breakdown is. And it's funny, we just talked about that in our last episodes on knowing your credit score, because it's just not, the loan you're going to get on the mortgage, it's going to affect your interest rate or getting approved, but your car loan, your insurance, everything across the board is going to be based off of that credit number. So we've been telling people constantly, monitor that, stay on top of it. Really, it makes a significant difference. That bankruptcy, let's just say, for instance, you wrote my policy and I had a bankruptcy 7 years ago. So they're going to raise my rate slightly because of that. Well,
anything within the anything within 7 years, you aren't even eligible to go to that company. They won't raise your rate. You're not even eligible. They say, nope, no thank you, go call somebody else. However, like I said, if you called me and you told me you had a bankruptcy within 7 years, it's okay. I can find either high-risk carriers, but I wouldn't even go to a high risk, because unless there was another problem, but I would just go to this other carrier I write with that is a standard preferred company, have very good rates, and you would be happy. You would be happy, so it wouldn't affect you.
Okay. All right, so let's just say that buyer has good credit. They haven't filed for bankruptcy. Obviously, they're okay. We're approving them for a mortgage. The mortgage company's approving them. They're fine. So, other questions that I've had buyers call me for when they start calling around checking for insurance is, hey, do you know where the closest fire hydrant is, or where's the fire department?
Yes. Yeah, very, very important. So your rate is higher. So what we want to see is a fire hydrant within 1,000 feet from your property, which if you look at a football field, it's 100 yards, it's 300 feet. So if you could imagine a little more than 3 football fields, because 3 football fields would be about 900 feet. If you could picture that in your head and plop it in front of your house in any direction, if that 1,000 feet you have a hydrant in, that's great. It doesn't have to be right out front. You have one right out front of your house, it makes no difference if you have one 900 feet down the road. It just has to be within 1,000 feet. Then the next thing would be it needs to be within 5 miles from a responding fire department. So if you have both of those things, a hydrant within 1,000 feet and a fire department within 5 miles, you're going to get the best protection class rating. Now, some people do not have fire hydrants. A lot of red flag for people that don't have them is someone has well and septic. That means there's no city water usually. So if you have well and septic, there's a good chance you don't have a fire hydrant within 1,000 feet. So now you might have a fire department directly across the road. But Randy, the fire department's right across the street. I don't have a fire hydrant, but they're right here. Okay, well that's good. It doesn't matter again if it's right across the street or 4.5 miles down the road. You are now getting the second best rate because you still have the fire department responding within 5 miles, but no hydrant. The worst is when you have no hydrant and no fire department within 5 miles. Some companies, you're not eligible with them. Other companies, you're going to pay a really high rate.
They're assuming that if a fire breaks out, they're going to be looking at a total loss or a much higher loss than if they can respond quickly within 5 miles and hook right up to the water wall.
So exactly. So the closer they are within 5 miles, they can get there and get the fire out, hopefully before it destroys the home. The other thing is no hydrants. Now they're using tankers that are coming in and they're pumping the water from a tanker. Well, unfortunately, that tanker is going to run out of water soon. And if the fire's bad enough, now there's no more water in the tanker and it has to go refill. And now the fire keeps going. That's what they look at.
Gotcha. So the other one I get is when I get the call and they say, do they have an alarm system at the house?
Yeah, so alarm systems definitely help you out. You know, you would think they actually would help you out a little more. The average savings, if you have a central alarm system for fire and burglary, the combination, and it has to be monitored to a central station monitoring where they call the police or fire department if the alarm goes off. It's probably between $70 and to $150 maximum savings per year, but every little dime helps. So if you do have an alarm system and it is hooked up to central station fire and burglary, then you want to let your insurance companies know. And all you have to do is you call your alarm company up. They get this phone call all the time, ADT, Schloman, whoever it might be, and say, hey, listen, can you send me an alarm monitoring certificate? My homeowner's insurance will give me a credit for this. Oh, yeah, sure, no problem. They'll email or fax it right to you, and then you get that to your insurance agent, and then they can send it to the carrier and get that credit applied to you right away. Now, some people might only have burglary. They don't have fire. Well, that's fine. Now it's just a little lower of a discount. You're still going to get something for having a burglary. Now, if you don't have any alarm system at all, you're going to get the standard discounts like smoke detectors, carbon monoxide, fire extinguishers, deadbolt locks. Most people have those 4 things. So you'll get a small discount at least for having those things.
Okay. Now, you know, there's other riders we can add to this, because I know like mine has a sewer backup rider, or mold also, or whatever it may be.
Yeah, so sewer and water backup is a very big one. It's very common. There's a lot of claims that occur with this, especially when people have a basement and they have a sump pump down there, and maybe the sump pump fails or mechanically breaks down. It's a bad storm. It's working too hard and it goes, or the storm pushed the power out and you have no generator to keep that water from pumping out. Well, it's going to back up. And you have that nice finished basement, and your basement doesn't even need to be finished. You might have mechanical stuff down there, washer, dryer, refrigerator, hot water heater, furnace, and now the water's backing up and you got a foot of water in your basement. If you don't have the water sewer backup endorsement on the policy, you got no coverage. The adjuster's going to come out and say, yeah, you don't have that endorsement. So you want to make sure you have that. Most insurance companies, they start off at $5,000 in coverage for that, and some max out there. It just depends on the company. Other companies will give you an option to go to 10, and other companies will even let you go to higher limits. Now, the higher you go on those limits, the higher that premium charge is going to be. Usually for $5,000 or $10,000, you might be looking at like $100 a year to have that coverage. Another important one's equipment breakdown coverage. Basically, any new appliance that you purchase, whether it's washer, dryer, refrigerator, stove, hot water heater, HVAC system. If it's a newer system and something happens to that and it's no longer covered under the warranty, maybe you didn't opt to get the 5-year extended warranty at Lowe's when you picked up the brand new washer and dryer, you just took the 1-year manufacturing, and then 1 year and 1 day later something happened to that item. Well, this would cover under the equipment breakdown coverage for someone to come out and repair or replace that item. Now, it's not like a home warranty type of endorsement. You got a 20-year-old hot water heater and it blew. Well, time to go get a new one. That's its life cycle. So each item in the house has a life expectancy at the time of the loss, and it depends on the manufacturer. Like higher end stuff like Viking appliances, they last typically a lot longer than something else that might be a lower end thing. So it's not as clear as day, but it's at the time of the loss. The adjuster goes out and then they determine the age of that piece of equipment, whether it would be should have this happened or not, and then that's when they figure out whether it's determined coverage or not. Another thing is service line coverage. This is very new. Most of people that get a gas bill or electric bill might get something in the mail once in a while that says, hey, for $4.99 a month extra to your bill, we'll protect you for all these things that your homeowner's carrier doesn't cover you for. And they are right. Usually this was never covered. This is the outside connection of your house, any utility line to the street connection. If anything ever happened there, that was always your problem. And the average cost to repair something like that is between $4,000 and $8,000 when it occurs. So if you elect to get the service line coverage now, which some companies offer, not everybody does, but I have carriers that do, you would have coverage for this in the case of that happening, which is, You get a sewer line under your front yard break, they got to come dig it up, replace it, repair it. You have to go maybe through your landscaping or your sidewalk to get to it, whatever the case might be. So it's important to maybe have that. And these endorsements I'm talking about, equipment breakdown, service line, they're cheap. They're like $20, $30 a year for that kind of stuff.
You know, a hot.
Now,
I was going to say, hot
Go
topic
ahead.
in real estate is always mold.
Yeah, that's a sticky situation too. So, you know, a lot of people get mold in their house just because it's a damp foundation or whatever, and they go in their basement and there's mold forming down there. Well, that's not covered for that kind of a situation. When mold is covered, it has to be triggered by a covered loss. So something has to occur. A storm happens, a tree falls and hits your house and puts a hole in your roof, and now water's coming into your property. This is a covered loss. What has occurred is covered. And now because of the water coming in your house from that covered loss, mold forms. Now it's covered, the cleanup of that mold to your property. But most companies also, again, have a sublimit, and usually that sublimit is $25,000. You can elect to go higher to $50,000, just costs a couple of dollars more. But most people have about $25,000 in that situation. So the only time mold's covered is during a covered loss that may occur at the property, and there's always a limit of how much is covered.
So if we go back on that other one, you know, the sump pump failed during the storm because it was overtaxed, and the basement flooded, which caused mold to occur, then I'm okay.
Coverage. You're okay, because now it has to be, something has to trigger the covered loss to provide coverage for the mold.
Okay. But if I own a house
Yep.
down the shore, and you know they're notorious, especially the lower levels where there's garage, sometimes living space, we always see mold down there just because of the climate down there, the humidity level, the moisture level, and everything. That none of that's covered unless it was caused by an event, right?
Exactly. Yep.
And now this is the one that always, an example I had, you know, the old adage, if a tree falls in the forest and nobody hears it, did it fall? But with you guys, if the tree falls in my yard and it didn't break anything, it didn't get covered.
Yeah, this is one that comes up a lot, and a lot of people have no idea about this until it happens. And a lot of people get very upset, and sometimes you lose relationships with neighbors when this occurs. So when the tree falls, your tree falls, Stephen, on your neighbor's house, it's your neighbor's problem. Steve could be a nice guy because it was his tree and say to the neighbor, hey, I feel really bad about this. What was your deductible? That was $500. Well, here you go. Let me cover your deductible for you. Or Steve could come over with his chainsaw and assist with any help that he could provide to that neighbor. But Steven doesn't need to do any of that stuff. That's just being a nice neighbor if you felt like doing it. That tree falls and hits the house of his neighbor. It's their problem. They have to go through their insurance company to repair the damage and remove the tree and so forth. Same as if it's Stephen's tree hit his neighbor's car. Same thing. It's not Stephen's problem. Now, if it doesn't hit anything, Stephen's tree just lands in someone's backyard. It's not Stephen's problem. And unfortunately, guess what else? It is also not going to be covered under the homeowner's policy of Stephen's neighbor because it has to hit something. If it just hits the ground, there's no coverage for that. Even if Stephen's tree falls in his yard, doesn't hit anything, doesn't damage anything, just lands in the yard, Stephen's problem. He has to clean that up. The insurance does not cover the pickup or cleanup of that.
We're talking.
So if basically you want the tree to hit something, you want to hit a fence, a shed, a house, a car, and now you got coverage.
Yeah, the one I had was actually in Berlin. It was somebody we both know, and it was a big tree, and it went down, and it stayed in his backyard, and it went down. And initially they said, you're not covered. Then he realized it actually yanked and snapped his sprinkler lines. So that, I think that triggered his damage. So then he got the cleanup covered. So it's any damage that occurs, right? If it breaks my fence,
any type of property that it damages, now it's covered.
But that would be $1,000 plus. I mean, depending on the size of that tree, that could be a serious expense that you thought you were covered for, and you're not.
Exactly. Yeah. Yep. It's not a cheap cleanup. These tree guys charge you a lot of money, so people have to understand that tree falls in your yard, it's your problem unless it hits something. Now you're happy because now they're going to fix everything.
But there's the other side to it, is right, because I know I talked to your dad after the last storm, and it clipped the corner of his house and took off part of his gutter and all, but now you got to evaluate it. Do I want to even file this claim, right?
Right. Is it worth it? Because that's a good point. Now you're covered. You got a claim now that it's covered. That tree did hit it. But in my dad's situation, he had about maybe $1,500 in damage, and the tree wasn't that big. So, I went over with a friend and we just cut the tree up and was done with it. But you turn the claim in now. I mean, you got coverage for that. There's coverage. So I don't want to cut it up. I want it fixed. I go through my insurance company. There's $1,500 in damage, basically, between the cleanup of the small tree and the damage that occurred to the roof and the gutter. So my dad has a $1,000 deductible. So the insurance company says, here's $500. You don't want to turn a claim like that into you. You want to bite the bullet if you can. Some people don't have the extra money laying around, but if you can, you want to bite the bullet on any small claims. What I consider a small claim, anything under $5,000. If you have a claim at your property that's under $5,000, if you can't afford to just do it yourself, fine, turn it in. But try to bite the bullet, because what happens now is that goes against you. It doesn't always typically raise your rate, depends on the company. Some companies do have a surcharge if there's a claim you turn in, but not everyone does. So you have that one claim, you go through the insurance company, you get $500 paid, like in my dad's example, minus his $1,000 deductible. And he has another claim a year and a half from then. $8,000, $10,000 claim. It doesn't matter whether it's $1,000 or whatever the price may be. Now he's got two claims under his belt in a 3-year period. Once you have two claims in a 3-year period, most insurance companies out there that I work with, now they can, in their underwriting guidelines, send a non-renewal letter to you and cancel your policy due to the past claim history. So that's what it is. Two claims in a 3-year period, they can cancel you. It doesn't matter how much was paid. It was only $500 on the one and $1,000 on the second claim. It doesn't matter. We don't look at what was paid. We look at there was two claims in a 3-year period, so you're no longer eligible with us. So now you call me up and say, Randy, I'm being non-renewed for these two past claims. And I say, that's horrible. I really feel bad, but I can get you some quotes. So now you're paying $800 a year with your policy that's about to be canceled, and I come back to you and say, well, I got you a rate, it's $1,350 now, and your deductible is no longer $1,000, it's $2,500 deductible. Due to the claim history, they want to usually give you a higher deductible, and you're stuck in this higher rate for about a 3-year period. Once the 3 years pass and the claims fall off, now we can remarket you and get you back to the regular preferred company.
Okay, all right. So we go back to that person that was buying the house. I came across this several years ago, and I don't know if the client was, I'm pretty sure they were going through you and your dad, but I don't remember exactly. And they ran something on the house that the client was buying called a clue report, I think it was, where they pulled up a claim history on the property and demanded proof that the repairs were actually made. And in that case, we actually learned that the seller had lied to us about water damage in the past, because of the insurance that was paid out on.
Yeah. We do what's called a clue report. It's like a motor vehicle report for, if you're writing auto insurance, you have to run a motor vehicle report to find out if people have accidents or tickets. But in homeowners, they call it a clue report. And you put in the address and location, and as you're going through the quoting process, as I am, something will come up, a red flag. Wait, hold on, there's a claim here, and it'll say the date. It'll give a short description. It won't tell you a lot. It'll say like wind or fire or water. It'll give you a quick description of what it was, and then it'll have a payment amount, $5,000 or whatever it might be. So then I call up the underwriter and say, hey, listen, this is a new purchase. They're going to settlement in a month from now, and this claim's coming up. And then the insurance company goes, oh, okay, it was a prior owner, no problem. And the underwriter will release it, and basically they delete the claim from there, so it looks like it never existed. I tell the buyers, hey, I don't know if you guys are aware of this, but there was a $5,000 water claim there. I don't know what occurred. You might want to talk to the prior owners and make sure they fixed everything. So it does come up. Now, if you're living at the property and you're just refinancing, and I'm doing the quote and that comes up, and it may not have been your claim. It may have, you bought the house 2 or 3 years ago, but it's coming up 4 or 5 years ago. So I say to you, was this your claim? No, I don't know anything about it. I can go back and say it was a prior owner. So it's nothing to do with these people. They've only lived here for 2 years.
Okay. So that makes sense. So it's kind of like a Carfax, but on a house.
Right. So what happened with the prior people isn't going to follow you with the new people. So it's like, you know, what affected that house previously before you got there is not going to affect you.
Okay. But I've had where they've come back and asked, you know, the seller to provide proof that the whatever the claim was, water damage, tree damage, whatever, proof that it was repaired and taken care of.
So
Sure.
I've never had any of my carriers ask for that. If they know it's going to settlement and a new purchase, they're not going to find out about that. I guess most insurance companies figure, well, why are they going to buy a house if there's this damage? It's going to be clear that it was there. So they just assume it was repaired and replaced. I don't know. Like I said, there's those carriers you can go deal with directly that I don't write with, and maybe they have a guideline like that where if this pops up, they want to see something like that. It's possibly, but none of the ones I work with would ask for care about that.
So that could be Jake and his doctors at 2:00 in the morning, maybe, right?
Mm-hmm. Exactly.
All right, so we'll go back to the buyer now. We talked about a single family, but as we all know, so there's all kind of different properties out there: condos, townhouses, single families, twins, duplexes, everything like that. So when we're buying, let's say, a townhouse versus a condominium, there's a big difference to me, and I know there's a huge difference to you, but a lot of people use those terms a little interchangeably, right?
Yeah, it's a big deal, and it is crazy because a lot of people that live in a condo or are buying a condo, they might have a 2,000 square foot condo, and it looks, it feels, it smells, it everything like it's a townhouse, because most condos people think of are like basically an apartment unit, a small unit, 1-2 bedroom, 1 bath, and it's just a little building with like tons of other buildings tons of other units in that one building, like maybe 15 units in one building, and then there's another building next to it with 15 units in it. Townhouses are normally not like that. Townhouses would be maybe 3 or 4 connected. Sometimes you get the 6 to 8 row townhouse, and you have usually 2 end units, and then you have the middle units, the interior units there. In a townhouse situation, you need a regular homeowner's policy, just like anyone who has a single family home that's not attached to anything. So you're having what's called an HO3, and that's a homeowner's policy. It's a normal homeowner's policy. So if you have a townhouse, you own that property. And if something happened to it, burns to the ground, you have to rebuild that property. Inside contents you're worried about, and the outside of the actual structure, it's your responsibility in a townhome. In a condo, it's completely different. And this is where we have to make sure that it's really a condo or it's not. And the way you tell if it's a condo is basically you have to contact the condominium association or the homeowners association, and they would tell you, yes, you're only responsible for the interior contents, the walls in. You are not responsible for the actual structure. We have a condominium association policy which covers the building. So the condominium fire occurs, the building burns down to the ground. The client that has one of the units in there does not rebuild and is not responsible for the damage of that property. The condominium association policy, they call it a master policy, will rebuild that entire building back up. Then each unit owner would have what's called an HO6, and that HO6 would cover them from the walls in and their contents inside. And what I mean by the walls in is in that situation, place burns down, the homeowners association, condo association master policy rebuilds everything. You walk up to your house and it looks perfect. It looks all brand new again. You get to your door and you open the door to your unit. There's no carpet on the floor now or hardwood. There's no cabinets. There's no countertop. There's no sink. There's no paint on the wall. There's drywall, but no paint. There's no light fixtures. There's no toilet. There's no shower, tub. All that stuff is your responsibility from when they say the walls in. So it basically, you're getting a bare unit when you walk back into this place after it's rebuilt. So that's where the HO6 comes in. It replaces those things. Puts your carpet in, puts the paint on the wall, puts your light fixtures, your countertops, cabinets, all those types of things. And usually that's covered in an HO6 under what's called improvements and betterments, coverage A. And that covers all the things that do not fall out of the unit. So you take the condo associations, build the roof off the top, flip it upside down and shake it. Whatever falls out is your contents, your appliances, your clothing, your furniture. That's your contents. That's under coverage C. You would want that coverage to cover those type of things. But coverage A, improvements and betterments, under the coverage A, is the things like the paint. The paint's not going to fall off the walls. The countertops and the cabinets aren't going to fall out. The toilets and the tubs, they're you want to call them fixtures, I guess. They're the things that you want to have under coverage A. Now, some condominium HO6 policies, they provide split limits like I'm talking about right now. Coverage A for improvements and betterments, and then coverage C, which is just your contents, the things you bring in it. Other companies do what's called a combined single limit. So they take the contents and all those improvements and betterments and combine them into one figure. So you could have like a policy with split limits, $50,000 on your improvements and betterments and $50,000 in contents, or you could have a combined single limit, which would be $100,000 in everything. I can't tell you what's really better than one or the other. I kind of think combined single limit is, because at the time of the loss, you might have more damage to your improvements and betterments than you do content. So if you have $100,000 combined single limit, you have up to $100,000 versus a split limit. If you had $60,000 worth of improvements and betterments damage, we only had a $50,000 limit, so you're short $10,000. So I guess I would rather have a combined single limit policy.
Okay, that makes sense. So that's the HO6, and that the HO6 is, in my understanding, is very similar to what we would call renter's insurance, right? Similar?
No, because in an HO6, you own the property. Okay, on an HO4, that's a renter's policy. You don't own where you're living. You're living there, but it's not your house. Somebody else owns it. And, a lot of people that rent don't realize that you could get a renter's policy, a minimum policy, $25,000 in contents. It provides some loss of use coverage, which I'll tell you what that is in a second, liability and medical payment coverage. You could get a policy for like $125, $150 a year for something like that. That's nothing. And the loss of use that I was talking about, in a minimum policy, you maybe get like $5,000. So if there was a fire at the property that you're renting, well, the landlord that owns that property has no responsibility of putting you somewhere else. It's not his responsibility. And the contents inside of your unit is not his responsibility. So when that fire happens, if you don't have this $125, $150 a year policy, you're SOL. You just lost everything. You got to figure out where you're going to go now, and you got to figure out how you're going to replace everything inside it. So you have this policy now, and it'll pay you for a place to go, up to $5,000 in like a minimum policy. Some companies 3 or 4. It just depends on the coverage limits you select when you call me up. But a minimum policy, it will provide that expense for you to go stay at a hotel or wherever you need to go during that time frame until the property's rebuilt and you can get back in it.
All right, that makes sense. So the HO6, everything inside the property, the kitchen, the bath, the flooring, the paint, I'm insuring all that. In the HO4, the renter policy, I'm only insuring my belongings and nothing more.
Yes. Yep. Exactly.
And then, what other things should we be looking for? I know, like, we touched briefly on when we were talking about binding in the beginning, but like, I just bought my wife a new diamond earrings, right? Unless I call and tell you, they're not covered, right?
Yeah, so there's always some coverage for what's called unscheduled property. So that's here you buy the diamond earrings, you don't tell me, and something happens. There could be a sublimit of $2,000 or $3,000, maybe $5,000, depending on the policy, for coverage with that. Mine is your deductible, of course. But whenever you have something of value, $10,000 Rolex watch, whatever it might be. You want to specifically list that on there, and it's called an inland marine policy. It's a rider to your policy, and this would be covered for theft, mysterious disappearance, damage done to it. Maybe you didn't lose it, it didn't disappear, it wasn't stolen, but now just the diamond fell out or something. And there's no deductible involved. So at the time of the loss, there's no money out of pocket. You might have $1,000 deductible on your policy, but when you pay for the rider, there's no money out of pocket in that situation.
So let's use the Rolex. Right? Let's $10,000 Rolex. What are we looking at? $100, $200?
Every 5,000 is usually roughly around $60 a year, I estimate. Give or take. Again, each company has a little higher rate than other companies. So in that $10,000 Rolex, you're looking at about $120 a year to insure it.
Right. So you're that's not a bad deal, and it's damaged too. So right, you have the Rolex, it falls off your wrist. I don't know how that would occur, but like hypothetically, falls off your wrist, and you accidentally drive over it with the car, and it gets destroyed. So you're saying that Rolex gets replaced, no deductible, nothing, or my wife, she accidentally drops her ring down the toilet and flushes it by mistake, right? That
covered.
If it was on, it's covered, right? Okay, but I'm assuming you can't have unlimited numbers of mysterious disappearances on your things you buy.
Yeah, exactly. So, yeah, exactly. It's just like the other claims. Once you have a few of them under your belt, the company can then decide to either, cancel you, or in this situation with jewelry, say, hey, we're not going to insure any of your jewelry anymore.
Okay.
And there is a separate rate too, Steve, if you keep your jewelry in a vault. Some people may have, 2 Rolex watches and a really nice diamond necklace for their wife, and they're worth $15,000, $20,000 each item, but they only wear them 2-3 times a year, maybe at a special event or an anniversary. They go to the safety deposit box, they take it out, they wear it for that day or two, and then they return it. So the rates for that are extremely low. So the insurance company knows you're only wearing it once or twice a year. It's sitting in a vault the rest of the time. So if you do have a vault, you make sure your agent knows that, and you would be paying a much lower rate. So that $10,000 Rolex watch at $120 a year, I was estimating, might only cost you $15 a year when it's in a vault.
Now that's a bank vault. That doesn't mean I bought a safe for my house, right?
Exactly. At a bank, we would need the name of the bank and the address of the bank.
Proof that I have the safety deposit box and
yeah, we don't need any proof. And I mean, I don't, can't speak for every company, but we would just need to know the name of the bank and the address of the bank it's being kept at.
Okay. So let's touch on another one that affects a good portion of our area we are, which is, flood insurance. Obviously there's flood maps from FEMA that determine who's in what area, what level, or whatever it may be. And I had one recently, and I think you were writing the policy on it, where it was like a small corner of the house was over the flood line, and like 90% of the house was not, but they still had to get coverage, right? Is that normally how?
Yeah, exactly. So any part of your property is inside of a flood zone. It could be just a little corner of the back of your property. Unfortunately, you're in that zone, and there are steps, and I don't know exactly what the steps are in the situation where just a sliver of the back of your property is. You got to jump through hoops of fire to go through the state and local government to get certain paperwork turned in, certified, and I don't know how much money and aggravation it costs, but I've heard of people being able to fight that, and then they can revise the map and take you out of that zone, and then you either don't have to have the coverage because now you're in an X zone. X zones, mortgage companies say you're not required to have flood insurance because you're not in a high-risk hazard zone. Anything in an A or V as in Victor, would be a high-risk hazard area, which if you're getting a mortgage or have a mortgage, you're required and must have flood insurance.
But if you're in those areas, even if you paid cash for the house, you'd be kind of crazy not to have some type of flood coverage, right? I mean, that'd be nuts.
Yeah, I mean, some of these areas definitely, and there's two types of markets out there. There used to just be able to go through FEMA, which is the federal government. Everybody knows that. That used to be the only place you could go. It doesn't matter what agent you talk to, the price is the same. It doesn't matter. No agent can come up with a better price when it comes to a FEMA policy. Then about a year and a half, 2 years ago, they started off with this private market, which is surplus lines. People probably heard of Lloyd's of London. They got involved with writing flood insurance. For the first time, people had an option now to go somewhere else. And these policies typically I've seen are coming in lower than the FEMA policies. And there's so many private markets out there now. I could get a quote for the same property for $500 a year, and through another private market, it's $1,500 a year. So if you call around or shop it around, and we have a lot of private markets here, we can find you the best rate for that policy, whether it's a FEMA flood policy or a private market flood policy.
Okay. So, a lot of this applies down the shore, and we talked about Ocean City before, so we'll do it again. A lot of the Ocean City twins are 2-unit condominium buildings, basically top and bottom, right? There's only 2 people in it. The 2 neighbors are the condo board and everything, and they have the master policy you talked about before that insures both units for fire damage and all that. And then they also have a master flood policy on top of that. Now,
yes.
Should someone down the shore that's involved in one of those situations, should they buy their own flood insurance, or is that master flood policy all they need, or is that all they can get? Can they augment it at all?
I would suggest that they should buy their own flood insurance, and it's for their contents in the inside. The master policy on the association that you're talking about for floods only going to cover the building. So if the building was damaged, that's where that policy would kick in. But if the building was damaged and you had a foot of water in your unit, and your contents and carpet and furniture was ruined, the Master Association's flood policy will not cover a situation like that. And that's where you want to get your own policy for your contents inside that unit. You would also want, on top of that, definitely like 100% an HO6, because you might think it's a duplex and it's your house, but it's really considered a condo. You formed a condo association in these 2-unit buildings. So you want to get an HO6 for your own liability, your own contents, and your improvements and betterments.
Okay. And then limits on our liability coverage and all, and we'll cover this last one that I want to get into before we let you go, because I know we've been going a while. So I had a pool put in, my premium went up really less than the jewelry rider went up. It was minimal. But now I've got added liability to myself. So, I have some assets. I want to protect myself. Everybody with a rental property, a shore property, a pool, I'm always telling them they should call you guys and talk about umbrella policies. So an umbrella is very important, and this is just like that renter's policy I was telling you about in HO4. It makes no sense that most people, especially people that have a lot of properties and assets, they want to protect themselves. It makes no sense that you don't have an umbrella policy. You could get an umbrella policy for as low as probably about $180 a year, and that would provide you $1 million of liability. You could go as high as $5 million, but at $180 a year, you get $1 million umbrella policy. What the heck's an umbrella policy? Never heard of it. It's exactly what it sounds like, an umbrella. It covers you over all your underlying liability limits on not just your homeowners, but your automobile and any other properties or motorcycles or boats that you have. So when you get an insurance policy, whether it's a boat, a home, an investment property, whatever it is, your cars, everything that you own has its own insurance policy on it. And every one of those insurance policies have a liability limit. Now, to get eligible for the umbrella, that liability limit on those policies have to be at a minimum of $500,000. So if you have a $300,000 limit, if you want to buy an umbrella, you're going to have to raise it to $500,000 from 3 to 5. And that you might say, oh my God, it's going to cost me a ton of money. No, to go from $300,000 to $500,000, it may only cost you an extra $30, $40 a year. It's not that much. Now you qualify though for the umbrella. So once you have everything satisfied on all the other policies that you have, let's keep this simple. You have 2 cars on an auto policy. You have 1 house. That's it. That's all you own. You don't have boats or anything else.
both of those policies, the auto must be at 250,000, 500,000 split limit, or 500,000 combined single limit to qualify for the umbrella. So let's say you have those limits. Now your homeowner's policy must have $500,000 limit. So now you qualify to buy the umbrella. You have everything you need. You go buy the umbrella. You only have 2 cars, 2 drivers in the household like you do, Steve, and you have your house. Well, that's about $180 a year for some situation like that for someone. Now, the more things you own a boat, you own a wave runner, you have a camper, and you have a shore house, and you also have 2 investment properties. Well, now it can start getting expensive, but not a lot of us have that. But even in that situation or example, maybe it's $500-600 a year, tops $1,000 a year, depending on how many properties and things you own. But it's very wise to have, because the way it works is you get in that auto accident. So they pay out you have the right limits that you need for the umbrella, 250,000, 500,000 per person per accident in an accident, and you severely injured someone, and now you're in a lawsuit for $1 million. Well, you got $500,000. That's all you got. Well, guess what? Umbrella kicks in. Now you got that extra $1 million. So now really you got $1.5 million. So now you're okay. Everything's fine. You don't have to worry about anything. So that's why you get the umbrella. It's to kick in when your regular limits are exhausted, and now they're not going to go after you, your wages, or any of your other assets to make up for the rest of that money.
Right. And I'm not covering legal expenses or anything, because the 2 policies are stepping in with their attorneys. And so
you're not paying it. Your auto carrier will step in and cover you for the auto accident. Now that gets exhausted. They go, here's 500,000. Now, boom, umbrella kicks in. We need another 500. There it goes. You have $1 million. Okay, here's 500.
Okay. And they slip and fall and drown in my pool, or?
Same situation. Yeah, if someone on your property gets injured or drowns in your pool, God forbid, yes, you would have 500,000 coverage at your home, and then boom, the umbrella kicks in for the extra $1 million. The more assets you have, the more wealthy you are, the things you own, the higher you might want to get that umbrella. I have people that have $5 million umbrellas here, and we have people that have $2 million umbrellas. Most commonly, though, most people have $1 million.
Right. And this makes sense for everybody, because we live in a litigious society, and there's a ton of attorneys out there that this is how they make their livings, basically, filing lawsuits against people. And you want to make sure you're covered, and you don't have to sell your house or deplete your 401k or your kid's child fund, your college funds, to fix this situation, because some attorney was able to write the paperwork right, and now your back is up against the wall. One other thing I wanted to touch on earlier, because we touched on dogs and pools and sliding boards and that kind of stuff, but what about firearms, weapons, that type of thing?
So most policies do cover firearms. It's a sub-limit. They give you up to 2, 3, 4, 5,000, depending, again, on the company, the type of policy you have. Every company is a little different. So there is usually coverage automatically for firearms in the house up to, a sub-limit always. If you have much higher values of guns laying around the house, you want to let your insurance company know. Same thing of fine arts. You have a bunch of, really nice collectibles, whether it's, memorabilia, sports stuff, or artists, like, things like that. People have signed guitars by, Van Halen. This stuff was used in a concert in 1970 or something. So, these things have values on them. You want to have these things specifically scheduled. And the rates for these things are not that high for that type of stuff.
So it's
really pretty inexpensive.
Right. That's the same as the watch or the earrings. Basically, if you have a really expensive collectible firearm or a large amount of firearms, right? It's the same thing.
Yes.
You're going to rider them so that they're insured separately. And then, God forbid, something were to happen with one of those firearms and you have the umbrella policy, that's also kicking in to help you as well, because you have a sub-limit from your homeowner's policy, right?
Well, only in a lawsuit. The umbrella kicks in only in a lawsuit. So if it's anything to do with firearms, it has nothing to do with the limits there that would be available. You would just be scheduling the firearms or fine arts collectibles, just like you did with the jewelry example with the Rolex watches, and there would be a rate you pay for to have them listed on the policy.
Okay. All right, that makes
But
sense.
the umbrella, just to be clear, is just for a lawsuit. It has nothing to do with anything else. You would just, umbrella kicks in for lawsuits only.
Okay, that makes good sense. All right, so you cover all of this stuff. You can handle it all, plus I assume life insurance, and you said the commercial line. So if I'm a contractor or whatever,
Yep.
you can look at the exact same thing for my workman's comp, for my equipment, for my liability insurance, and all of that stuff as well. So you're pretty much a one-stop
Yeah.
shop for the most part, right? Except for my health insurance.
Yeah, if you want me to insure your finger, I can even insure your finger. Like, and I'm not saying that jokingly. Like, pitchers, football athletes, and all, they do get insurance policies on their arm, or whatever it might be. That is why they're so good at it. And there's specialty markets. We can even insure, people for that type of thing. So God forbid they blew their arm out and they're a Major League Baseball player. They're making all this money now that their careers just ended. We can write policies for that too, believe it or not.
That's amazing. I thought they were always jokes. I thought that was always a joke, like insure your legs or your arm.
Hey, J Lo has an insurance policy for her rear end through Lloyd's of London in case something happens to it.
You're kidding, right?
No, not kidding at all.
I wonder what the policy would be for Kardashian for hers, because that's got to be a big policy.
Oh, I'm sure. Probably cost her, I would guess, over $100,000 a year, probably.
All right. Well, I'm going to let you wrap up. So if anybody has any questions on anything we touched on, we're going to put all your contact information in the show notes, but what's the best way for them to contact you, and what's the best times?
Basically, my office hours are, 8:30 a.m. to 4:30 p.m. Monday through Friday. Okay. And, I can be contacted through my office line, cell phone, or email, whatever anyone prefers. And I think you're going to provide all that information at the end of this, or do you want me to give that to them now?
You can give it to them now, but it'll be in the show notes too. It doesn't hurt to do belt and suspenders, so to speak.
Yeah, so, my toll-free number is at 800-448-5541. My direct extension is 308. My email address is rvdtann@iaiins.com. And my website is www.insuranceagenciesinc.com.
All right, perfect. Well, I appreciate your time. Had a lot of fun. And I'll see you Monday night at Rotary. And otherwise, have a great weekend.
Yeah, thanks for having me. Take care.
You got it. Thanks, everybody.
Bye.
We'll be talking to you at our next episode. Bye.